Welcome to the Lockshield Partners Podcast. We believe in financial literacy and love to provide quality information when it comes to areas around financial planning and how it impacts your life. To learn more about what we do and how we serve our clients, visit us at lockshieldpartners.com.
Dan, welcome back. We've got another edition of our Lockshield Partners podcast today. And today we're going to dive into the exception to the 10% early withdrawal penalty.
Yes.
So let me just kind of rephrase that real quick, because that's a mouthful in and of itself. We've talked about before that the typical age for penalty-free retirement distributions is 59 and a half.
Kind of an odd age, but whatever.
Whatever. It's been that way for a long time.
Yes.
But that's the age. If we take money out prior to that age, in most cases, there's going to be a 10% penalty on top of any other regular taxation that we would owe. The IRS, in their goodness, does give you a few exceptions to that rule. So maybe why don't you kick us off with one of the main ones that we can utilize?
Yeah, and the IRS, our experience in working with the IRS is when you're not trying to do something wrong, they're usually pretty reasonable to work with. So one of the exceptions, and this really falls into the category of someone who maybe is financially able to retire, but they're not 59 and a half yet. So it's the 72T distribution.
Also known as substantially equal periodic payments.
Of course, yes. 72T is the section in the code. So 72T says it is an exception to the 10% penalty as long as you take distributions for the greater of 5 years or until you reach the age of 59 and a half.
That's a mouthful.
It is a mouthful. Here's what it looks like in the wild. You're 53 years old and you have $1 million in the bank, or I'm sorry, in your 401k, or whatever number, 500,000, whatever it is,
or IRA,
or IRA. Yes. And you want to access that money. The IRS says, we will let you do that, but we don't want you using your retirement accounts as a piggy bank. We want to make sure that this is really for retirement. We want to make sure you're serious about this. So as long as you take substantially equal periodic payments for at least 5 years or until you reach 59 and a half, we won't charge you the penalty.
So for that 53-year-old, they would have to take those until they reach 59 and a half.
That's correct.
Because that's the greater of those two.
That's correct.
On the flip side, if we have somebody that's 57, they could not stop at 59 and a half. They would have to go there until age 62.
That's exactly right, Clark.
With that 72T, Dan, there's 3 different types of formulas. We're not going to get into that today. They're fairly complex that tell us how much income we can take out. But one thing to be aware of for people that consider this option, it's very dependent on what interest rates are.
That's exactly right.
So when the Federal Reserve increased the federal funds rate a couple of years ago, that created an opportunity for people to utilize the 72T that maybe hadn't really existed in the prior decade.
Yeah, that's right. They could get a more meaningful payment.
Much more robust.
From there. One thing that I will note on that is you're allowed to make a change once. And this really goes back to 2008 when the market just was hanged. So the idea was if somebody was in a 72T taking money and their account dropped 50% or dropped a lot because the market dropped 50%, they were cannibalizing their retirement account. So the IRS says, we'll give you a chance to reset your amount once. If you miss a payment, if you do not take substantially equal periodic payments, they will treat every payment as a premature distribution, and you will have the 10% penalty on every payment since you started. So it's a good planning tool, but it doesn't fit everywhere.
Yeah, no doubt. Let's talk about another early retirement exclusion, I guess you could say, and that's the 55 and separated from service.
Yes.
So this really applies to 401ks or employer-sponsored plans.
Correct.
And the basis of this is if someone separates from service, retires from their employer, the calendar year that they turn age 55 or after, they can access funds from the employer-sponsored plan without penalty up until they're age 59 and a half.
Yeah, that's right. So where that would come in really handy is a scenario where you have someone who maybe is able financially to retire, or maybe just wants to access their money, but they're not 59 and a half. So walk us through what that might look like in real life.
Yeah, we see this in practice a lot.
We see this probably more than the 72T.
This is a pretty common scenario. So let's say that we have somebody that turns age 55, or they're about to turn age 55, and they know, you know what, I'm ready. Financially, I'm ready to retire. I'm in good shape. Maybe they have other income sources, or maybe they're doing something part-time or whatever. Even if they're not going to be fully dependent on that 401k money, we would recommend that they leave it there.
Gives them the access.
It does not make sense to roll that money into an IRA, because as soon as it goes into an IRA, that 55 and separated from service rule goes away.
That exception only applies, does not apply to IRAs.
It has to stay in the employer-sponsored plan. So we have a lot of folks who choose to leave those funds there for that window of time. And
until they hit 59 and a half.
Until they hit 59 and a half. At that point, it usually makes sense to roll it into an IRA. But whether they need it or not, it's nice to have the flexibility to access it.
We like flexibility when it comes to finances.
Absolutely. Absolutely. A couple other exceptions to that 10% rule, Dan, are unreimbursed medical expenses. So if a family undergoes basically a financial hardship due to medical expenses, the IRS allows you to take a portion that's there's a formula. It has to be over a certain percentage of your adjusted gross income. So they are flexible in that regard, which is nice. And they also have an exclusion there for higher education expenses. We see this in practice too. So if you have kids or grandkids or whatever going to college, that may be a funding source, and there's pros and cons to that. If you want to touch on that a little
Sure. Well, and I'll just say that the little nooks and crannies for the exceptions, again, these are all for if you are under 59 and a half and avoiding the 10% penalty.
Right.
So the higher education, the medical expenses, the first-time home buyer, or it doesn't need to be a first-time home buyer, but a lifetime limit. Those nooks and crannies are situations where we see, but not very often.
Right.
I think the two bigger ones with the exception is the 72T, which is 5 years or until 59 and a half, whichever's greater.
Yeah.
Or the 55 and separated from service.
Yes. Yeah, those are big ones. Last one I'll throw out there that is kind of a exception to all this stuff. We've talked before about the Roth IRA.
Love them.
Not that there's a silver bullet in financial planning, but that's pretty darn close.
Comes pretty close.
We can access the cost basis, which is a fancy word for whatever you've contributed.
Yep.
Whatever you've put into your Roth IRA, you can access that whenever you want to. You don't have to meet some specific criteria. You don't have to ask. You don't have to apply. You simply take it.
Seems like we've done a podcast on that before.
Probably somewhere along the line.
Yeah.
If you have any questions about the early withdrawal penalty exceptions, make sure to check us out at lockshieldpartners.com.